There is a ghost in the machine of modern capitalism. It's a phantom that haunts boardrooms, a silent puppeteer that pulls the strings of even the most powerful executives, forcing them to make decisions that are not just wrong but catastrophically, predictably foolish. It is the reason why big, successful companies, giants of industry with armies of MBAs and access to limitless data so often make breathtakingly dumb moves. They launch products no one wants. They enter markets they can't win. And most destructively of all, they buy other companies for absurd prices, incinerating billions of dollars of shareholder wealth in a single ill-conceived press release. Warren Buffett, the master investor who has built a fortune the size of a small country's GDP, has spent his entire life studying this ghost. He has given it a name. He calls it the institutional imperative. It is, in his words, the lemming-like tendency of corporate management to mindlessly imitate the behavior of their peers, no matter how irrational or unproductive that behavior may be. This single principle is the invisible hand that guides the vast majority of companies toward mediocrity, and often toward disaster. Understanding it, truly internalizing it, is the closest thing to a silver bullet in the world of investing. It is the one test Buffett uses to separate the CEOs who will merely run a company from the rare few who will make you truly rich. The institutional imperative dictates that if a competitor builds a new factory, you must build one too, even if the industry is already drowning in overcapacity. It insists that if a rival launches a flashy new marketing campaign, you must match their spending dollar for dollar, regardless of the return on investment. It whispers in the ear of every CEO that growth is paramount, even if that growth is unprofitable and comes at the expense of the company's long-term health. And its most seductive, most dangerous siren song is the call of the mega-merger, the company-transforming acquisition that promises synergies and market dominance but almost always delivers dilution, disappointment, and debt. The costly mistake this prevents is perhaps the single greatest destroyer of value for the average retail investor. Owning a company that commits corporate suicide by making a huge, dumb acquisition just because everyone is doing it. You see the headlines, you hear the hype, and then you watch your investment get cut in half as the promised synergies evaporate and the crushing weight of the new debt smothers the balance sheet. The financial transformation that awaits you on the other side of this understanding is profound. You will stop looking at companies as abstract ticker symbols and start seeing them as collections of human decisions. You will learn to ignore the charismatic CEO with the grand vision and instead find the quiet, rational leader who treats your investment as if it were their own family's savings. You will develop an almost allergic reaction to corporate jargon and a deep appreciation for candor and clear, simple math. By mastering Buffett's test, you will learn to spot and invest in companies run by independent, rational managers. This will lead you to a portfolio that grows not through the sugar high of foolish empire building, but through the deep, compounding power of smart capital use. You will align your financial future with the tiny fraction of business leaders who are genuinely focused on one thing: increasing the intrinsic value of the business on a per-share basis. This is not just another stock-picking trick. This is a fundamental shift in your entire investment strategy. A new lens through which to view the entire world of business and finance. It is the key to unlocking a level of portfolio growth you may have thought was reserved for Wall Street insiders. It is the final promise of rational investing. To truly grasp the insidious nature of the institutional imperative, we must first understand its DNA. We must see it not as a complex financial theory, but as a deeply human story of pressure, conformity, and the quiet death of common sense. For Warren Buffett, this was not an academic lesson learned in a classroom. It was a painful, first-hand education forged in the dying mills of New England. His foundational anecdote, the crucible in which his most powerful investment principle was formed, is the story of Berkshire Hathaway itself, not the global financial juggernaut we know today, but a doomed textile company in Fall River, Massachusetts. In 1964, Buffett took control of Berkshire Hathaway. On the surface, it seemed like a classic value play. The company's stock was trading for less than its working capital, a so-called cigar butt investment where you could get one last free puff. But Buffett soon realized he hadn't just bought a cheap stock, he had bought a front-row seat to the slow, agonizing decay of an entire American industry. The textile business was terrible. Foreign competition, primarily from Japan, was relentless and brutal. They had lower labor costs and more modern equipment. Every year, the American textile industry had to run faster just to stay in the same place. The profit margins were razor thin, and the capital requirements were immense. The looms and spinning machines were monstrously expensive, and they wore out. To stay even remotely competitive, a company like Berkshire had to constantly reinvest what little profit it made back into new equipment. This was the trap. This was the institutional imperative in its purest, most destructive form. Every other textile executive in New England was doing the same thing. They'd attend industry conferences, read the same trade publications, and talk to the same equipment salesmen. The consensus was clear. To survive, you must modernize. You must pour more capital into the business. It was the only way. So year after year they did. They took the meager earnings generated by their dying businesses and plowed them back into new machines that would, hopefully, make them slightly more efficient than their struggling neighbors. But it was a race to the bottom. Each new investment barely earned its cost of capital. It was like adding a new, slightly faster deck chair to the Titanic. The fundamental economics of the ship were fatally flawed. The iceberg of foreign competition had already struck, and the vessel was taking on water. Buffett saw this with horrifying clarity. He calculated that over the previous decade, the textile industry as a whole had earned a return on capital that was less than the interest rate on a government bond. It was, for all intents and purposes, a value-destroying enterprise. Every dollar reinvested was a dollar that would have been better off literally anywhere else. Yet the CEOs of these companies, men who were by all accounts intelligent and hardworking, continued to pour money down the drain. Why? Because everyone else was doing it. To do otherwise, to admit that your industry was finished, and that the best course of action was to liquidate the business and return the capital to shareholders, was unthinkable. It was an admission of defeat. It went against every instinct of a manager, whose identity is tied to running and growing an enterprise, not dismantling it. It was corporate heresy. This experience was seared into Buffett's mind. He realized that the greatest threat to a business wasn't necessarily a brilliant competitor or a disruptive technology. It was the company's own management, blindly following the herd off a cliff. He ran the textile business for 20 years, from 1965 to 1985, a decision he later called one of his biggest mistakes. He tried to be rational, limiting new capital expenditures, but even he felt the pull of the imperative. He later wrote in a shareholder letter, "I had an abundance of capital tied up in a business that had been run by able and honest people, but their abilities and integrity were unable to overcome the fundamental economics of the textile industry." That single sentence is the epitaph for thousands of failed companies. The lesson was brutal but invaluable. The institutional imperative is a force of nature, as powerful as gravity. It pushes companies to expand into areas they shouldn't, to match the foolish strategies of their rivals, and, most importantly, to reinvest capital in activities that promise little to no return, simply because that is what is expected. The psychological principle that underpins this corporate madness is one of the most powerful forces in human society: social proof, also known as herd behavior. On a primal level, our brains are wired to believe that if a lot of people are doing something, it must be the right thing to do. This was a fantastic survival mechanism on the African savanna. If you saw 100 of your fellow proto-humans suddenly sprint in one direction, it was not the time for independent analysis. The correct response was to sprint with them and ask questions later. The ones who stopped to ponder whether the approaching predator was truly a threat did not pass on their genes. We are the descendants of conformists. In the modern boardroom, however, this instinct is a liability. A CEO looks around and sees their 5 biggest competitors all making huge investments in, say, a new, unproven technology. The rational part of their brain might say the return on this looks terrible, the risks are high, and it doesn't fit our core strategy. But the ancient, powerful herd instinct screams, "Don't get left behind. If they're all doing it, they must know something you don't. You'll look like a fool if this is the next big thing and you're the only one who missed it." The fear of being wrong alone is far greater than the fear of being wrong with everyone else. There's a strange comfort in collective failure. If you make a bold, contrarian bet and it fails, the blame falls squarely on you. Your career could be over. But if you make the same foolish investment as all your peers and it fails, you can simply say, "Well, the entire industry misjudged the market. It was an unforeseeable event." There is safety in the herd, even when the herd is stampeding towards a cliff. This is amplified by another bias called groupthink, a term coined by psychologist Irving Janis. It describes a phenomenon where a group of intelligent people, in a desire for harmony or conformity, make irrational decisions. Dissent is discouraged. Doubts are suppressed. The leader's apparent preference is quickly adopted by the group, and anyone who raises an objection is seen as not being a team player. Imagine a corporate strategy meeting. The CEO, already influenced by what competitors are doing, proposes a major acquisition. The chief financial officer might have reservations about the price. The head of operations might worry about the difficulty of integration. But will they speak up? Often, they won't. They see everyone else nodding in agreement. They don't want to be the sole voice of negativity. The pressure to conform, to support the team's direction, is immense. The institutional imperative, therefore, is not just a business phenomenon, it's a psychological one. It's the manifestation of social proof and groupthink on a multi-billion-dollar scale. It explains why a company like Kodak, which actually invented the digital camera, could fail to embrace it. The institutional imperative within Kodak was to protect its film business, which was fantastically profitable. Every executive's career, their bonuses, their identity, was tied to film. To pivot to digital would be to cannibalize their own core business, an act of self-disruption that felt far more dangerous than simply continuing to do what everyone else at Kodak had always done, even as the world was changing around them. Understanding this psychological underpinning is critical for any serious investor engaged in business analysis. It allows you to see that a company's actions are often driven less by cold, hard financial analysis and more by a deep-seated, irrational fear of being different. So how can we, as retail investors, translate this knowledge into a practical tool? How do we apply a mental model to detect the institutional imperative at work before it destroys our capital? The blueprint is something I call the empty room test. It's a thought experiment combined with a practical research process. Imagine the CEO and their executive team are in a completely empty, soundproof room. There are no newspapers, no industry reports, no Wall Street analyst calls, no television screens flashing what their competitors are doing. In this room, they have only one thing: the raw, unadulterated data of their own business and the market it serves. They have their financial statements, their customer feedback, their operational metrics. Now ask yourself, based on this internal data alone, would the decision they just announced still make sense? Would they still choose to build that new factory if they didn't know their rival just broke ground on one? Would they still launch that particular product if they weren't trying to copy a competitor's hit? Would they still make that acquisition if it wasn't the hot thing to do in their sector? To run this test, you become a detective. First, you must understand the prevailing narrative in the industry. Read the last 3 quarterly conference call transcripts from your company and its top 3 competitors. What are the buzzwords? Is everyone suddenly talking about AI integration, synergistic platforms, or expanding into the Asian market? Make a list of these common themes. This is the sound from outside the empty room. Second, dive into the company's own numbers. Ignore the CEO's commentary for a moment and look at the financial statements. Is the core business growing? Are margins expanding or contracting? What is the return on invested capital? Is the company generating free cash flow? This is the data times inside times the empty room. Third, connect the two. Does the big strategic initiative, the one everyone is talking about, logically follow from the internal data? If a company's core business is slowing and its margins are shrinking, Does it really make sense to spend billions on a massive acquisition in a completely new field? Or is this a desperate Hail Mary pass, a panicked reaction to seeing their peers diversify? The institutional imperative thrives on vague justifications. Look for them. When a CEO justifies a decision by saying things like, "This is a strategic move to position ourselves for the future," or "We must invest to maintain our leadership position," be very suspicious. These are often code for, "I have no idea what the financial return will be, but all our competitors are doing it, so we have to as well." A rational leader, one operating from inside the empty room, will justify a decision with numbers. They will say, "We are making this investment because we project it will generate a 15% return on capital, clearing our internal hurdle rate. Here is the math." The empty room test is a powerful tool for any retail investor because it forces you to separate the narrative from the facts. The narrative is seductive and easy to follow. The facts are often boring and require more work to uncover. But the facts are where the truth about management quality and future shareholder value lies. By consistently applying this mental model, you begin to train your brain to spot the difference between a decision driven by herd behavior and one driven by independent, rational thought. This is the first step in building an investment strategy immune to the siren song of corporate conformity. To fully appreciate the wisdom of avoiding the institutional imperative, we must spend some time examining its opposite, the path of the 99%. This is the road most investors travel, and it is littered with blown-up accounts and shattered dreams of financial freedom. The antithesis of Buffett's approach is not just a different strategy, it's a completely different mindset. The 99% don't fear the institutional imperative, they embrace it. They actively seek it out. The average investor is drawn to the herd like a moth to a flame. They chase hot industries and disruptive companies, not because they've done a deep business analysis of the underlying economics, but because that's what everyone on financial news channels and social media is talking about. The dot-com bubble of the late 1990s is the quintessential example. The institutional imperative at the time was clear. Get a .com in your company name, go public as quickly as possible, and spend whatever it takes to acquire eyeballs, a metric that had suddenly, inexplicably, replaced profits as the measure of success. Did it make rational sense? Of course not. But everyone was doing it, and for a while, it worked. Stocks of companies with no revenue and no profits soared to absurd valuations. The herd was euphoric. The retail investor who followed the 99% path jumped in with both feet. They weren't buying businesses, they were buying stories. They were buying the social proof that came from seeing their neighbors and colleagues get rich overnight. They ignored the fundamentals because the narrative was so compelling. When the crash came, it was devastating. Companies that were household names like Pets.com disappeared. Trillions of dollars in market value evaporated. The 99% who had followed the herd off the cliff were wiped out. A Buffett-style investor applying the empty room test would have seen the madness for what it was. They would have looked at the financial statements of these .com darlings and seen a complete absence of profits, a terrifying rate of cash burn, and no plausible path to sustainable earnings. They would have concluded that these decisions were not being made based on rational internal data, but purely on the external pressure to conform to the .com mania. They would have stayed on the sidelines, perhaps looking foolish for a year or two, but ultimately preserving their capital while the herd was slaughtered. This pattern repeats itself in every market cycle. Whether it's the Nifty 50 stocks of the 1970s, the housing bubble of the mid-2000s, or the clean energy fads of the 2010s, the dynamic is always the same. An industry or theme becomes popular. The institutional imperative kicks in, forcing companies to participate. The 99% of investors pile in, chasing the momentum. And eventually, the fundamentals reassert themselves, and the bubble bursts. The path of the 99% is a path of reaction. They react to news, to price movements, to the opinions of others. They are constantly asking, what is the market doing? The path of the rational investor is a path of independent thought. They are constantly asking, what is the business worth? By choosing to deliberately stand apart from the herd, by making the institutional imperative your enemy rather than your guide, you fundamentally alter the odds of long-term success. You exchange the fleeting thrill of chasing trends for the enduring power of owning quality businesses run by rational people. The financial connection between the institutional imperative and shareholder returns is not abstract. It is direct, mathematical, and brutal. Let's return to the foundational anecdote of the New England textile mills. Imagine Berkshire Hathaway in 1965 generated $1 million in profit. The institutional imperative dictated that this money should be reinvested into the textile business. Let's be generous and say that new equipment could eke out a 4% return on capital. That $1 million reinvested would generate $40,000 in additional profit the next year. Now consider the alternative. Buffett, resisting the imperative, could take that same $1 million and invest it outside the textile business. He could buy a piece of a good business, like See's Candies, which consistently earned returns on capital of 25% or more. That same $1 million redeployed would generate $250,000 in additional profit. The difference is staggering. It's a six-fold increase in the velocity of wealth creation. Over years and decades, this difference compounds into a chasm. The company following the imperative plods along, its capital slowly eroding in a low-return enterprise. The company that defies the imperative and allocates capital rationally sees its value explode exponentially. This is the core engine of shareholder value. It's not about revenue growth. It's about the return on incremental invested capital. A company can grow its revenues by 20% a year, but if it has to spend so much on new assets that it only earns a 3% return on that investment, it is actively destroying value for its owners. Conversely, a company that only grows revenues by 5% but can do so with very little new capital, generating a 50% return on any incremental investment, is a compounding machine. This is a crucial concept for any retail investor to understand. The financial statements tell this story if you know how to read them. Look at a company's balance sheet over 5 years. How much has total assets or property, plant, and equipment grown? Now look at the income statement. How much have profits, or net income, grown over that same period? If assets have ballooned but profits have stagnated, you are likely looking at a victim of the institutional imperative. Management is pouring capital into the business, but the business is a leaky bucket, unable to generate attractive returns on that new capital. This is the difference between good growth and bad growth. Bad growth is simply getting bigger for the sake of getting bigger, a hallmark of the institutional imperative. Good growth is getting more profitable on a per-share basis. By learning to identify and avoid companies trapped in low-return reinvestment cycles, you protect your portfolio from the slow, grinding destruction of capital. You instead position yourself to benefit from the explosive power of rational capital allocation, the true source of all long-term portfolio growth and the foundation of any successful wealth management strategy. This is how you beat the S&P 500 over the long run, by owning businesses that are more intelligent with their capital than the average company. The most spectacular value-destroying manifestation of the institutional imperative is the siren song of the mega-merger. There is nothing that excites the animal spirits of a CEO, the media, and often the 99% of investors, quite like a big, bold, transformative acquisition. It makes headlines. It promises growth, synergy, and market dominance. But the grim reality, backed by decades of data from sources like KPMG and Harvard Business Review, is that somewhere between 70% and 90% of all mergers and acquisitions fail to create value for the acquiring company's shareholders. They are, in a very real sense, a triumph of hope over experience, of ego over economics. And the institutional imperative is almost always the driving force behind the disaster. For this pillar, there is no more powerful or painfully honest foundational anecdote than one of Warren Buffett's own greatest mistakes: the acquisition of Dexter Shoe Company in 1993. This wasn't a small error. Buffett himself has called it his worst deal ever. a multi-billion-dollar blunder that serves as a permanent flashing warning sign against the dangers of straying from one's core principles. Dexter Shoe was a solid, American-based shoe manufacturer in Maine. It was run by a man Buffett admired, Frank Rooney. The company had a decent brand and a consistent, though not spectacular, record of profitability. In 1993, Buffett fell in love with the business. He saw a durable American brand that he believed had a competitive advantage. He was so confident, in fact, that he decided to do something he had almost never done before. He bought the entire company, not with cash, but with Berkshire Hathaway stock. He paid $433 million, issuing 25,203 shares of Berkshire A stock. At the time, this seemed like a perfectly reasonable deal. The problem was that Dexter Shoe's supposed competitive advantage was a mirage. Almost immediately after the acquisition, its profitability began to collapse. Low-cost foreign manufacturing, the same force that had decimated Buffett's original textile business, came for the American shoe industry. Dexter's cost structure was simply too high to compete. It was a business in terminal decline. Had Buffett paid in cash, it would have been a $433 million mistake, painful but manageable. But because he paid with Berkshire stock, the true cost of the error was astronomical. Those 25,203 shares of Berkshire stock, which were worth $433 million in 1993, would today be worth well over $10 billion. That is the true opportunity cost of the mistake. He didn't just lose $433 million. He traded a piece of one of the greatest compounding machines in history for a melting ice cube. So why did Buffett, the master of avoiding the institutional imperative, fall for this? In his own candid postmortems, he admits he got swept up. He was charmed by the management, he liked the idea of owning a simple, all-American business, and he misjudged the durability of its competitive position. In a sense, he succumbed to his own form of institutional thinking. The idea of buying a quote-quote good business with good management is a Buffett mantra, and he applied the label to Dexter without doing the ruthless, forward-looking analysis of the industry's economics that the situation demanded. He ignored the lesson he had learned so painfully in the textile mills. This story is a powerful testament to the allure of the big deal. It shows that even the greatest investor in the world is not immune to making a catastrophic error when he lets a compelling story or his admiration for a management team cloud his judgment about the underlying business economics. The Dexter Shoe disaster is the ultimate cautionary tale. It teaches us that acquisitions are fiendishly difficult to get right. It shows how quickly a seemingly durable competitive advantage can evaporate. And it proves, in stark financial terms, that the price you pay, both in dollars and in opportunity cost, is everything. It's a permanent reminder that when a CEO gets that gleam in their eye about a transformative acquisition, the rational investor's first reaction should not be excitement, but extreme skepticism. The underlying psychological principles that drive CEOs to pursue these value-destroying mega-mergers are a toxic cocktail of ego, optimism, and flawed mental accounting. At the forefront is a powerful cognitive bias known as the winner's curse. This phenomenon, first observed in auctions, describes the high likelihood that the winning bidder in any competitive auction has actually overpaid. Why? Because the person willing to bid the most is often the person with the most optimistic and therefore likely most inaccurate assessment of the item's true value. The corporate takeover process is nothing more than a high-stakes auction. A target company is put in play, and multiple potential acquirers start bidding. The CEO of each acquiring company is surrounded by investment bankers, lawyers, and internal staff, all of whom have a vested interest in the deal getting done. The bankers get huge fees, the executives get to run a bigger empire. The narrative becomes about winning the deal, not about making a smart investment. As the bidding climbs, the CEO's focus shifts from a rational calculation of intrinsic value to the emotional desire to beat the other bidders. To lose the deal would be a public humiliation. To win, on the other hand, is a triumph, a validation of their skill and aggression. And so, they make that one final, extravagantly high bid. They win the auction, and in the process, curse their own shareholders, with a massively overvalued asset that has almost no chance of ever earning a decent return on the purchase price. This is compounded by another powerful bias, overconfidence, particularly what psychologists call the planning fallacy. This is our natural tendency to overestimate our ability to execute on complex plans and to underestimate the time, cost, and risk involved. When a CEO announces a merger, they always present a slide deck filled with rosy projections about synergies. These are the supposed cost savings and revenue enhancements that will result from combining the two companies. They'll claim they can save hundreds of millions by eliminating redundant corporate staff, consolidating IT systems, and leveraging combined sales forces. The problem is, these synergies are almost always a fantasy. Integrating two distinct corporate cultures is monstrously difficult. Key employees from the acquired company often leave. IT systems are incompatible. The projected cost savings never materialize, and the synergistic new products never get off the ground. The CEO who fell for the winner's curse then becomes a victim of the planning fallacy, as their beautifully optimistic projections collide with messy reality. Finally, after the deal is done and the problems start to mount, a third bias kicks in, commitment bias, also known as the sunk cost fallacy. Having invested so much capital, time, and personal prestige in the acquisition, the CEO cannot bring themselves to admit it was a mistake. Instead of cutting their losses, they double down. They throw more good money after bad, trying to fix the unfixable integration problems, further destroying shareholder value in the process. They are psychologically incapable of admitting defeat. For the investor conducting a thorough financial analysis, understanding these biases is crucial. It means you must treat all management projections about synergies with extreme prejudice. You must assume they are wrong, not by a little, but by a lot. It means that when you see a competitive bidding war for a company, the winner is almost certainly a stock you want to avoid, if not short. It's a recognition that the CEO is not a perfectly rational economic actor, but a human being subject to the same emotional and cognitive flaws as the rest of us, only with billions of your dollars at their disposal. To protect our portfolios from these psychological traps, we need an applied mental model, a practical instruction manual for dissecting any proposed or recently completed acquisition. This tool is the Acquisition Autopsy Checklist. It's a forensic examination that any retail investor can perform to determine whether a deal is likely to create or destroy shareholder value. It consists of 5 critical questions. Question 1. What is the premium being paid? The premium is the difference between the acquisition price per share and the target company's stock price before the deal was announced. A 20 to 30% premium is typical, but when you see premiums of 50%, 80%, or even 100%, red flags should immediately go up. A massive premium means the acquiring CEO believes they can create an immense amount of value over and above what the market thought the company was worth. This is a claim that requires an extraordinary amount of evidence, and it's usually a sign of the winner's curse in action. A company paying an 80% premium has to run twice as fast just to stand still. They have to generate 80% more profit from the acquired assets than the previous management, just to break even on the deal. The odds of this are vanishingly small. Question 2. Where are the synergies coming from and are they believable? Read the press release and the investor presentation. Are the synergies specific and cost-based, or are they vague and revenue-based? Cost synergies, like closing a redundant headquarters, are hard but at least plausible. Revenue synergies, like cross-selling our products to their customers, are notoriously difficult to achieve and should be almost entirely discounted. A good rule of thumb is to take management's synergy estimate, cut it in half, and then ask if the deal still makes sense at that lower number. If it doesn't, it's a bad deal. Question 3. How is the deal being financed? Is the acquirer using its own excess cash, or is it taking on a mountain of new debt or issuing a ton of new stock? A cash deal is generally preferable, as it shows the company has the financial strength to make the purchase without diluting its owners or putting the balance sheet at risk. A highly leveraged deal, one funded by debt, is extremely dangerous. It adds significant financial risk and can cripple the combined company if there's an economic downturn. A deal financed with stock, like Buffett's Dexter shoe mistake, should be scrutinized heavily. The CEO is essentially saying that their own company's stock is less valuable than the company they are buying. This is often a sign that management believes its own stock is overvalued. Question 4. What is the acquirer's track record? Is this CEO a serial acquirer? Go back and look at their last 3 major acquisitions. How did they perform? Did the promised synergies materialize? How has the company's stock performed relative to the S&P 500 since those deals were announced? Past behavior is the best predictor of future behavior. A management team with a history of smart, disciplined acquisitions deserves the benefit of the doubt. A team with a history of overpaying and underdelivering deserves nothing but your skepticism. Question 5. How is executive compensation structured? This is a deeper level of corporate governance analysis. Look in the company's proxy statement. Is the CEO's bonus tied to metrics like growth in revenue or growth in company size? If so, they are incentivized to do big deals, regardless of whether those deals are profitable. A well-structured compensation plan ties bonuses to metrics like return on invested capital or growth in free cash flow per share. This aligns the CEO's interests with the shareholders' interests. By systematically running every major acquisition you encounter through this 5-point autopsy, you build a powerful defense against value destruction. You move beyond the hype of the headlines and engage in the kind of rigorous business analysis that separates successful investors from the 99%. The antithesis of this careful, skeptical approach is the path followed by the 99% of investors who invariably get swept up in the excitement of the big deal. For them, a mega merger is not a cause for concern, but a reason to celebrate. They see it as a sign of strength, ambition, and vision. This mindset was perfectly captured during the disastrous AOL-Time Warner merger in 2000. Arguably the worst acquisition of all time. At the peak of the dot-com bubble, internet darling AOL announced it was acquiring the old media giant Time Warner for $164 billion. The media went into a frenzy. It was hailed as a new media paradigm, a visionary combination of content and distribution that would dominate the 21st century. The 99% of investors bought the story hook, line, and sinker. They cheered the deal. They bid up the stock of both companies. They ignored the flashing red lights that a proper acquisition autopsy would have revealed. The premium was enormous. The synergies were almost entirely of the vague, revenue-based variety. The strategic fit was questionable at best, mashing together 2 wildly different corporate cultures. It was a deal born not of industrial logic, but of institutional imperative. The desperate need of an old media company to get a piece of the new media action, and the hubris of a new media company that thought its inflated stock was a currency that would never lose its value. The rational investor, the one who had learned the lessons of the institutional imperative, would have seen this as a moment of peak insanity. They would have seen the collision of 2 bubbles, the internet bubble and the merger mania bubble, and run for the exits. But the 99% saw only growth, size, and the promise of a glorious future. What followed was a corporate catastrophe of epic proportions. The promised synergies never appeared. The cultures clashed violently. The internet bubble burst, vaporizing AOL's value. The combined company was saddled with debt and strategic confusion. Within a couple of years, the company was forced to take a goodwill write-down of nearly $100 billion, at the time the largest in corporate history. The stock collapsed, wiping out hundreds of billions in shareholder wealth. The investors who had cheered the deal were annihilated. This is the path of the 99%. They are seduced by narratives. They mistake size for strength. They confuse activity with progress. They cheer for empire building because it feels exciting, failing to understand that empires are often built on the backs of impoverished shareholders. They don't do the hard work of financial analysis required to see the truth behind the headlines. They follow the herd, and just as with AOL Time Warner, the herd often leads them right over a financial cliff. Avoiding this fate requires a conscious decision to adopt a contrarian, skeptical mindset, especially when confronted with the market's most celebrated and hyped-up deals. The direct financial connection between a foolish acquisition and shareholder ruin is stark and undeniable. The math of value destruction is not complicated. Imagine Company A has a market value of $10 billion. It decides to buy Company B, which has a market value of $2 billion. In a fit of winner's curse enthusiasm, Company A pays a 50% premium, acquiring Company B for $3 billion. The combined company now has the $10 billion of value from Company A, plus the $2 billion of intrinsic value from Company B. The total value of the combined enterprise, before any synergies, is $12 billion, but Company A paid $3 billion for Company B's assets. They have spent $3 billion to acquire something that is only worth $2 billion. They have in a single transaction vaporized $1 billion of their shareholders' capital. That money is gone forever. It has been transferred from Company A's shareholders to Company B's shareholders. The only way for Company A's shareholders to get that money back is through synergies. In this case, the management of Company A must find a way to create at least $1 billion in new, incremental value from the combination just to break even on the deal. They have to be so much better at running Company B's assets than Company B's own management was that they can generate an extra $1 billion in present value. This is a monumental task. As we've discussed, the vast majority of synergies are illusory. So what typically happens is that the $1 billion of shareholder value is permanently lost. The acquirer's stock price will, over time, reflect this destruction. This is why the stocks of acquiring companies so often fall on the announcement of a big deal. The smart money in the market immediately does this math and realizes that the acquirer has overpaid. The impact on the balance sheet is also devastating. Let's say Company A financed the $3 billion purchase with debt. Suddenly, their balance sheet has $3 billion in new liabilities. Their interest expense on the income statement skyrockets, reducing net income. Their financial flexibility is gone. They can no longer invest in their own core business or weather an economic downturn, because all their cash flow is going to service the debt they took on for the foolish acquisition. This is how a single bad decision by a CEO, driven by the institutional imperative to do a deal, can cripple a healthy company for a decade or more. For the retail investor focused on portfolio growth, this is the ultimate unforced error. By simply learning to identify and avoid companies led by empire-building CEOs, you can sidestep one of the biggest and most common sources of permanent capital loss in the stock market. Your goal in stock picking is to find businesses that are compounding your capital, not incinerating it. The acquisition autopsy isn't just a defensive tool. It's a critical part of your offensive strategy, ensuring that your capital is only deployed in companies managed by leaders who understand that their primary job is not to build the biggest company, but the most valuable one on a per-share basis. If the institutional imperative is the disease, and the mega-merger is its most deadly symptom, then what is the cure? The answer lies in finding the opposite of the conformist, empire-building CEO. It lies in identifying a rare breed of leader that Buffett calls the rational resistor. This is the executive who possesses the independence of mind, the intellectual honesty, and the moral courage to defy the herd, ignore the fads, and make decisions based on nothing but the long-term economic realities of their business. This is the CEO who will make you rich, and finding them is the core of Buffett's management-focused investment strategy. The foundational anecdote for this pillar, Buffett's archetypal example of the perfect rational CEO, is the story of Tom Murphy, the longtime head of Capital Cities/ABC. Murphy was, by Buffett's own account, the best business manager I've ever met. He was not a flashy celebrity CEO, he rarely gave interviews. He wasn't a visionary in the Silicon Valley sense. What he was a master of business fundamentals and a ruthless allocator of capital. He and his partner, Dan Burke, took a tiny, struggling television station in Albany, New York in the 1950s, and through decades of disciplined, intelligent decision-making, built it into a media empire that was ultimately acquired by Disney in 1995 for $19 billion. The story that best illustrates Murphy's genius for resisting the institutional imperative occurred in 1985. At the time, Capital Cities was a successful but second-tier media company. The three major television networks, ABC, CBS, and NBC, were the kings of the industry. They were the establishment. And they were run with a bloat and inefficiency that was legendary. They had massive corporate headquarters in New York, huge news divisions with bureaus all over the world, and layers upon layers of overpaid executives. This was the institutional imperative of network television. You had to project an image of power and prestige. Then, in a move that stunned Wall Street, Tom Murphy's much smaller Capital Cities announced it was acquiring ABC, a company more than 4 times its size. This was a minnow swallowing a whale. Most observers expected Murphy to be overwhelmed by the ABC culture. They thought he would be forced to conform to the lavish, inefficient ways of the network television business. They could not have been more wrong. Murphy and Burke walked into ABC and applied the same ruthless logic they had applied to every business they had ever run. They operated from the empty room test. They ignored how things had always been done at a network. They asked a simple, brutal question of every single expense. Does this help us win? They immediately sold the company's opulent headquarters building in Manhattan, leasing back only the space they absolutely needed. They eliminated entire layers of management. They famously questioned the need for a massive news bureau in a city where they already had a local affiliate who could cover the story. They were called cheap, brutal, and unsophisticated by the media establishment. But they weren't being cheap, they were being rational. They understood that the institutional imperative at ABC had led to a cost structure that was completely disconnected from the economic reality of the business. By cutting the bloat, they dramatically increased the profitability of the network. They didn't just run ABC better, they transformed its financial DNA. What Murphy demonstrated was the power of an independent mind. He was not influenced by the prestige of owning a major network. He was not intimidated by the established culture. His only loyalty was to the math, to the return on investment. Buffett was so impressed that he helped finance the deal, making one of the most profitable investments of his career. Tom Murphy's story is the perfect blueprint for the rational resistor. It's a story of focusing on what truly matters, profitability and cash flow, and ruthlessly ignoring everything else. It's about having the courage to look at an entire industry's standard operating procedure and declare it to be foolish. These are the leaders an investor should seek to partner with. They are rare, but finding just a few of them over an investing lifetime can be the difference between mediocre returns and true, life-changing wealth. The psychological principles that allow a CEO like Tom Murphy to resist the institutional imperative are the mirror image of the biases that trap their peers. Instead of relying on social proof, they engage in what is known as first principles thinking. This is the mental process of breaking down a complex problem into its most basic, fundamental elements and then reassembling them from the ground up. It's about reasoning from what is known to be true, rather than reasoning by analogy or by what others are doing. When the entire television industry said, a major network must have a prestigious headquarters in Manhattan, that was reasoning by analogy. Tom Murphy, using first principles, asked, what is the fundamental purpose of our office space? It is to house the people and equipment necessary to produce and broadcast television shows. Is owning a massive, expensive skyscraper on 6th Avenue the most efficient way to achieve that purpose? No. By reasoning from first principles, he arrived at a conclusion that was radically different from, and vastly superior to, the industry consensus. This type of thinking requires a rare form of intellectual courage. It's the ability to think for oneself even when, and especially when, that means standing in opposition to the crowd. Another key mental tool of the rational resistor is the concept of inversion, popularized by Buffett's partner, Charlie Munger. Instead of asking, "How can we be successful?" a leader who practices inversion asks, "How can we fail?" They then work diligently to avoid those sources of failure. So instead of asking, "How can we build a great television network?" Murphy and Burke effectively asked, "What would destroy a television network?" The answers would be things like a bloated cost structure that makes you uncompetitive, a loss of focus on your core audience, taking on too much debt for a foolish acquisition, or alienating your key talent. By identifying all the paths to failure, they could systematically erect barriers to prevent themselves from going down them. This is why they were so focused on cost control and operational efficiency. It wasn't about being cheap. It was about avoiding the single biggest source of failure in the media business: letting your costs get out of control. This is a profoundly different CEO mindset from the typical focus on growth at all costs. The visionary CEO is obsessed with the upside. The rational CEO is equally, if not more, obsessed with avoiding the downside. They understand that a single catastrophic mistake can wipe out years of hard-won progress. A final psychological trait is an almost fanatical devotion to intellectual honesty. The rational resistor is not afraid to admit mistakes. They don't fall for the sunk cost fallacy. If an initiative isn't working, they kill it quickly, rather than throwing good money after bad. If an acquisition turns out to be a disappointment, they acknowledge it and move on. This honesty builds trust with shareholders and creates a corporate culture where truth is valued over politics. When you find a leader who consistently demonstrates first principles thinking, a focus on avoiding stupidity through inversion, and a commitment to intellectual honesty, you have likely found a rational resistor. These psychological traits are the bedrock upon which long-term shareholder value is built. They are the invisible assets that don't show up on a balance sheet, but are far more valuable than any factory or brand name. How can a retail investor, with no direct access to the CEO, apply a mental model to identify these rare rational resistors? The single best tool we have is the annual shareholder letter. Most investors either ignore these letters or skim them for a few buzzwords. This is a massive mistake. The shareholder letter, especially one written by the CEO themselves, is a direct window into their mind. It is the best place to apply what I call the CEO letter deconstruction method. This method involves reading the letter not for what it says, but for how it says it. You are looking for specific clues that reveal a rational, shareholder-oriented mindset. Clue number 1. Candor about mistakes. Does the CEO openly and honestly discuss the company's failures from the past year? Do they take personal responsibility? The typical CEO letter is a work of fiction, a public relations document designed to paint the company in the best possible light. Problems are ignored, and failures are blamed on macroeconomic headwinds or other external factors. A rational CEO, in contrast, will often spend more time discussing what went wrong than what went right. Look at Buffett's own letters. He is famous for dissecting his mistakes, like Dexter Shoe, in excruciating detail. This isn't false humility. It's a sign of intellectual honesty and a commitment to learning. A CEO who can't admit mistakes is a CEO who will repeat them. Clue number 2. Clear and consistent metrics. How does the CEO measure success? Are they talking about vague concepts like synergy and transformation? Or are they focused on a hard, quantifiable metric like growth in intrinsic business value per share or return on invested capital? A great CEO will define their yardstick for performance and then report on it year after year, in good times and in bad. A bad CEO will constantly change the goalposts, highlighting whatever metric happens to look good that particular year. If they talk about revenue growth one year and user growth the next, and adjusted EBITDA the year after that, they are trying to confuse you. Look for consistency and clarity. Clue number 3. Rational explanations for capital allocation decisions. The letter should clearly explain why the company chose to do what it did with its profits. If they repurchased stock, did they explain why they believed the stock was undervalued? If they made an acquisition, did they lay out the financial rationale in clear, simple terms, avoiding jargon? If they retained the earnings, did they explain how they expected to reinvest that capital at a high rate of return? Tom Murphy was famous for this. He treated his shareholders like partners in the business. He explained the math behind his decisions as if he were talking to a financially savvy co-owner, which is exactly what a shareholder is. Clue number 4. The absence of corporate jargon. Is the letter written in plain English, or is it filled with buzzwords like leveraging our core competencies, optimizing our strategic footprint, and driving paradigm shifts? Jargon is a tool used to obscure, not to clarify. A CEO who thinks clearly can write clearly. A CEO who uses impenetrable jargon is often either trying to hide a lack of clear thinking or, worse, actively trying to mislead you. By applying this deconstruction method to a company's last 5 annual letters, you can build a remarkably accurate psychological profile of the CEO. You can determine if you are dealing with a promoter and an empire builder, or a rational partner who is genuinely focused on your long-term financial success. This is a skill that takes practice, but it is one of the highest return activities an investor can undertake. As always, the clearest way to understand the right path is to study the wrong one. The antithesis to seeking out the rational resistor is the path of the 99%, idolizing the charismatic, visionary CEO. Our culture is obsessed with the cult of personality. We are drawn to leaders who are bold, articulate, and have a captivating story to tell. We want to believe in the lone genius who can see the future and bend it to their will. The financial media feeds this obsession, creating celebrity CEOs who grace the covers of magazines and are treated like rock stars. The problem is that charisma has almost zero correlation with good CEO performance and rational capital allocation. In fact, it often has a negative correlation. The charismatic CEO is often a master storyteller, and the story they are best at selling is their own. They can convince boards of directors, employees, and, most dangerously, investors to follow them down paths that make no financial sense. The quintessential example is Adam Neumann at WeWork. Neumann was off-the-charts charismatic. He spoke with evangelical fervor about elevating the world's consciousness. He built a cult-like following within his company and convinced some of the world's most sophisticated venture capitalists to pour billions of dollars into his vision. He was the ultimate celebrity CEO. But if you ignored the charisma and applied the CEO letter deconstruction method by looking at WeWork's S-1 filing, its letter to potential shareholders, the reality was horrifying. The document was filled with bizarre jargon, self-serving related party transactions, and financial metrics that seemed to be invented out of thin air. There was a complete lack of candor about the company's monumental losses. The business model itself, signing long-term leases and renting out space on a short-term basis, was a recipe for disaster in any economic downturn. It was a fundamentally flawed business, masquerading as a world-changing tech company, all held together by the force of its founder's personality. The 99% bought the story. They were captivated by the vision. They clamored to get into the IPO. The rational investor, the one who looks for a Tom Murphy and not an Adam Neumann, would have been repulsed. They would have seen the lack of clear metrics, the absence of candor, and the focus on a messianic narrative over sound business principles. They would have recognized that Neumann was not a rational capital allocator, but a masterful salesman whose greatest product was himself. The eventual collapse of the WeWork IPO and the subsequent ouster of Neumann was a brutal lesson for those who had chosen charisma over competence. The path of the 99% is to fall for the story. The path of the successful investor is to scrutinize the numbers and the character of the person in charge. It is to deliberately seek out the boring, the methodical, and the rational. The Tom Murphys of the world don't make for exciting magazine covers, but they are the ones who will quietly and consistently build your wealth over the long term. The direct financial connection between rational management and shareholder returns is the magic of compounding in its purest form. A rational CEO's primary impact is on the company's return on equity, ROE, or return on invested capital, ROIC. By avoiding foolish acquisitions, shutting down unprofitable ventures, and reinvesting capital only in high-return opportunities, they systematically increase the rate at which the company's intrinsic value grows. Let's look at the financial performance of capital cities under Tom Murphy. From 1965 to 1995, a 30-year period, the stock of capital cities compounded at an annual rate of 19.9%. The S&P 500, over that same period, compounded at 10.1%. This difference may not seem dramatic on an annual basis, but over 3 decades, the result is an almost unbelievable chasm of wealth creation. $1 invested in the S&P 500 in 1965 would have grown to $17.80 by 1995. $1 invested in capital cities with Tom Murphy would have grown to $204.48. That's more than 11 times the return of the general market. This is not because the media industry was necessarily a fantastic business for all of those 30 years. It's because Murphy and his team were relentlessly rational in how they managed the capital entrusted to them. They were constantly making decisions that boosted the company's underlying profitability per share. They bought back stock when it was cheap. They used debt wisely to acquire undervalued assets. They controlled costs with a fanatical zeal. Each of these decisions in isolation might seem small, but compounded over decades, their cumulative effect was an economic hurricane. The financial statement of a company run by a rational resistor looks different. You'll see high and stable, or even rising, profit margins. You will see a consistently high return on equity without the use of excessive leverage. You will see the number of shares outstanding shrink over time as management intelligently repurchases its own stock. Each of these is a mathematical fingerprint of rational decision-making. When you invest in a company like this, you are not just buying a stock, you are harnessing a powerful economic engine. You are attaching your financial wagon to a management team that is culturally and psychologically programmed to increase the value of your investment. This is the ultimate goal of any investment strategy focused on management quality. It's about finding those rare leaders whose every action is aligned with your own financial interests. The difference it makes to your long-term portfolio growth is not incremental. It is exponential. The ultimate litmus test for a rational CEO, the single area where their skill and discipline are most visible, is in the practice of capital allocation. A CEO has, at its core, only 5 things they can do with the company's earnings. 5 choices. How they choose among these 5 options, year after year, is the most important job they have. It is more important than product strategy, more important than marketing, and more important than hiring. Excellent capital allocation is the secret sauce of all great long-term investments. For this pillar, our foundational anecdote turns to another of Buffett's great partnerships, his relationship with Katharine Graham and the Washington Post Company. In 1973, Buffett made a large investment in the Post, which was then run by K. Graham. Graham was a brilliant and courageous publisher, famous for her decision to publish the Pentagon Papers. But, by her own admission, she was not initially a sophisticated business person or capital allocator. At the time, the Washington Post Company was a collection of assets, including the newspaper, Newsweek magazine, and several television stations. The institutional imperative of the media industry was clear: reinvest, reinvest, reinvest. If you were a newspaper, you spent money to expand your circulation. If you were a magazine, you poured money into promotions to get more subscribers. Growth was the goal. But Buffett, now a major shareholder and board member, began to privately tutor Graham in the art of capital allocation. He explained that the 5 choices for the company's cash flow were: 1. Reinvest in the existing business. 2. Acquire other businesses. 3. Pay down debt. 4. Pay a dividend to shareholders. Or 5. buy back the company's own stock. He taught her that the critical question was not, how can we grow, but where can we deploy this next dollar of profit to get the highest possible return for our shareholders. This was a revolutionary concept in the media world. Graham became a brilliant student. She and her team began to analyze their portfolio of businesses not as a monolithic empire but as a collection of capital allocation choices. They realized that the newspaper itself was a fantastic business with a local monopoly, a true franchise. Reinvesting in the paper made sense, as it generated high returns. But they also realized that some of their other businesses were not nearly as good. Under Buffett's guidance, the company made a series of incredibly rational moves that went directly against the grain of the institutional imperative. For example, they began a massive share repurchase program at a time when their stock was incredibly cheap. They were essentially buying dollars of intrinsic value for 50 cents. This was a far better use of capital than, say, trying to expand the circulation of Newsweek, a business facing intense competition. Each share they repurchased made every remaining shareholder, including Buffett, slightly richer. They also sold off businesses that were earning low returns on capital. Even if those businesses were prestigious, they were unsentimental. If an asset could not generate an adequate return, it had to go, and the capital had to be redeployed somewhere better. This disciplined, rational approach to capital allocation, learned from Buffett, transformed the Washington Post company from a good company into a phenomenal investment. It demonstrated that capital allocation is not an innate skill, it can be learned. But it requires a CEO who is open-minded, intellectually honest, and willing to prioritize long-term per-share value over short-term institutional glory. The story of K. Graham's evolution is a powerful lesson that the quality of capital allocation is the single most important determinant of a company's long-term success. The underlying psychological principles that separate great capital allocators from poor ones revolve around the sophisticated handling of two key concepts: opportunity cost and the endowment effect. Opportunity cost is the simple but profound idea that the value of any choice is what you have to give up to make it. A great capital allocator lives and breathes this concept. When they consider reinvesting $1 into Project A, which they project will earn a 10% return, they are simultaneously thinking about Project B, which might earn 15%, or buying back their own stock, which might be the equivalent of a 20% return. They see the 5 uses of cash not as a menu to choose from, but as a competitive ranking. Every dollar is deployed to the highest return option available at that moment. The average CEO, trapped by the institutional imperative, barely considers opportunity cost. Their default setting is to reinvest in their own business, regardless of the returns. They suffer from a deep-seated bias to simply fund the projects their division managers propose. They are not thinking like an investor. They are thinking like a bureaucrat, simply dispensing a budget. The endowment effect is another powerful psychological barrier to good capital allocation. This is our tendency to overvalue things that we already own. A CEO looks at a division of their company, say a legacy manufacturing plant. They've run it for years. Their father might have worked there. It's part of the company's history. Even if that plant is only earning a 2% return on capital, they are psychologically incapable of selling it. They are endowed with it, and so they overvalue it. A rational capital allocator like Tom Murphy or Henry Singleton of Teledyne is ruthless in overcoming the endowment effect. They view their company's assets with a cold, dispassionate eye. They are constantly asking, if I didn't own this business today, would I buy it at its current value? If the answer is no, they know they should sell it. This requires a level of emotional detachment that is extremely rare. They are not empire builders, they are capital shufflers. They are constantly moving money from low-return assets to high-return assets, whether those assets are inside or outside their current company. A third critical principle is patience, or the ability to overcome the action bias. Most executives feel a constant pressure to do something. Wall Street analysts, the board, and the media are always demanding action and growth. This leads them to make acquisitions or investments just for the sake of activity, even when no good opportunities are available. The master capital allocator, in contrast, is perfectly comfortable doing nothing. They can sit on a pile of cash for years, waiting for the perfect pitch. Buffett himself is famous for this. He calls it having a punch card, with only 20 punches on it for his entire life. It forces him to wait for the truly exceptional opportunity. This ability to resist the action bias is a superpower in the world of corporate management. It ensures that when capital is finally deployed, it is deployed with maximum impact. To translate this theory into a practical tool for the retail investor, we can use a mental model called the 5 Use of Cash scorecard. This is a framework for analyzing and grading a CEO's capital allocation decisions over the past 5 to 10 years. You become the judge, and the CEO's track record is the evidence. First, you need to gather the data. You'll need the company's annual reports and cash flow statements. You're looking for 5 key numbers each year: capital expenditures, reinvestment in the business, cash spent on acquisitions, net debt reduction, dividends paid, and money spent on share repurchases. These are the 5 uses of cash. Now you create a scorecard and grade each category from A to F. For reinvestment in the business, look at the company's return on invested capital, ROIC. If the company has a high ROIC, say over 15%, and the CEO is heavily reinvesting in the business, that's an A. They are planting seeds in fertile soil. If the ROIC is low, under 10%, and they are still pouring money in, that's an F. They are violating the first rule of holes. When you're in one, stop digging. For acquisitions, use your acquisition autopsy checklist. Have their past deals been small, bolt-on acquisitions in their core area of expertise, or huge, risky, transformative deals? Did they overpay? Did the promised synergies materialize? A CEO with a history of smart, disciplined deals gets an A. A serial empire builder gets an F. For debt reduction, has the company been prudently paying down debt, strengthening its balance sheet? This is especially important for companies with a lot of leverage. A consistent effort to de-risk the company is an A. Taking on massive new debt for a foolish acquisition is an F. For dividends, is the dividend policy sensible? A mature, slow-growing company should pay a generous dividend. A young, fast-growing company with many high-return reinvestment opportunities should pay little or no dividend. A company that borrows money to pay a dividend it can't afford is an F. For share repurchases, this is a critical test. Look at asterisk when they bought back stock. Did they buy it aggressively when the stock price was low and undervalued? That's an A+. Did they buy it at the peak of a market frenzy when the stock was expensive, just to return cash to shareholders? That's a D. Did they issue a lot of stock options to executives and then use corporate cash to buy back shares to offset that dilution? That's an F. After grading each of the 5 categories for the last several years, you step back and look at the overall report card. A CEO with a scorecard full of A's and B's is likely a master capital allocator. You have found a rational partner. A CEO with a scorecard of C's, D's, and F's is a destroyer of capital. They are a manager you want to avoid at all costs. This methodical process removes emotion and narrative from the analysis. It forces you to focus on the CEO's actual decisions, not their words. It is the most reliable way for a retail investor to assess the most important skill that any chief executive possesses. The path of the 99% is, once again, the polar opposite. The average investor has a deeply flawed and simplistic understanding of capital allocation. Their primary, and often only, focus is on revenue growth. They think bigger is always better. They are drawn to companies that are rapidly expanding, opening new stores, launching new products, and entering new countries. They see this activity and interpret it as success, without ever asking the crucial follow-up question, what is the return on the capital being invested to generate that growth? A company that grows its revenue by 50% by burning through billions of dollars of shareholder capital and generating no profit is not a success, it is a failure. But the 99% of investors mesmerized by the top-line growth will often bid the stock up to absurd levels. They buy the sizzle of revenue growth and completely ignore the stake of profitability and returns on capital. This was the story of countless companies during the dot-com bubble and again in the more recent growth-at-any-cost era. Companies like Blue Apron or MoviePass achieved spectacular revenue growth, but their underlying business models were economic disasters. They were spending more to acquire a customer than the customer was worth. Every new sale actually pushed them deeper into the red. They were growing by shrinking. A rational investor, using the 5 use of cash scorecard, would have immediately given these companies an F for reinvestment. They were pouring capital into a business with negative returns. But the 99% chasing the growth narrative piled in, only to be wiped out when the unsustainable business models inevitably collapsed. Furthermore, the 99% often misunderstands share buybacks. They see it as financial engineering, or a way for executives to manipulate earnings per share. While this can be true if done at high prices, they fail to appreciate the immense power of a buyback done when a stock is undervalued. When a company with a durable competitive advantage buys back its stock at a discount to intrinsic value, it is one of the most intelligent, tax-efficient, and shareholder-friendly actions management can take. It directly increases each remaining shareholder's ownership stake in the business. The 99% cheers for a cash dividend, which is nice but tax inefficient, while often criticizing a value-accretive buyback. This fundamental misunderstanding of the mathematics of capital allocation is a major reason why the average investor underperforms the market. They are focused on the wrong metrics. They are rewarding CEOs for the wrong behaviors. They are chasing growth for growth's sake, and in doing so they are often unknowingly funding the destruction of their own capital. The direct financial connection between masterful capital allocation and your portfolio's bottom line is the engine of long-term compounding. The numbers are not subtle, they are profound. Consider 2 companies, Company Rational and Company Institutional. Both start with $1 billion in equity capital and earn $100 million in profit, a 10% return on equity. The CEO of Company Institutional follows the herd. He takes the $100 million in profit and reinvests all of it back into the business, even though the returns in his industry are mediocre. He manages to earn a 5% return on this new capital. The company grows, but its overall return on equity slowly declines as more capital is deployed at lower rates. The CEO of Company Rational is a master allocator. She sees that reinvesting in her core business only yields a 10% return. Instead, she takes the $100 million in profit and uses it to buy back the company's stock, which is trading at a significant discount to its intrinsic value. Let's say the buyback is equivalent to an investment that yields a 15% return. The next year, the company's equity base is smaller, so the same level of profit results in a higher return on equity. Over 10 years, the difference is astounding. Company Institutional has grown bigger, its revenues are higher, and it has more employees, but its stock price has barely budged because its profitability per share has stagnated. It has become a larger but less efficient enterprise. Company Rational, on the other hand, might not be much bigger in terms of revenue, but its earnings per share have soared. Its return on equity has consistently increased. Its stock price has multiplied many times over. It has become a smaller but vastly more valuable enterprise for its owners. This is the financial reality of capital allocation. It is the invisible force that determines whether a company is a value trap or a quote-unquote compounding machine. As an investor, your entire goal is to fill your portfolio with the latter and avoid the former. By learning to analyze a CEO's capital allocation decisions through a framework like the 5 use of cash scorecard, you are directly targeting the primary driver of long-term stock performance: You are moving beyond the superficial stories and headlines and focusing on the deep, underlying mathematics of wealth creation. This skill, more than any other, is what separates a casual stock picker from a true business analyst, and it is the key to building a portfolio that can fund your financial freedom. We have now reached the final pillar of our journey. We've defined the institutional imperative, dissected its most dangerous manifestation in the megamerger, learned to identify the rational CEO who resists it, and mastered the analysis of their most critical skill, capital allocation. Now we must synthesize this knowledge into a coherent philosophy for building an entire portfolio that is immune to corporate stupidity. This is about more than just picking one or two good stocks. It's about constructing a fortress of rationality, a collection of assets managed in such a way that the forces of herd behavior and institutional folly become your allies rather than your enemies. The foundational anecdote for this grand synthesis is Buffett's iconic investment in the Coca-Cola Company in 1988. On the surface, this seems like a simple investment in a great brand, but the real story, the one that ties all our pillars together, is a story of management change and a radical shift in capital allocation that unlocked decades of dormant value. For most of its history, Coca-Cola was a classic institutional imperative company. It was run by managers who saw their job as selling as much syrup as possible. They took the massive profits generated by the business and plowed them back into building more bottling plants, buying more trucks, and hiring more salespeople. They were focused on volume growth. This was not a terrible strategy, but it was far from optimal. The returns on these reinvestments were decent, but not spectacular. The company was growing, but it wasn't compounding shareholder wealth at its maximum potential rate. Then, in 1981, a new CEO named Roberto Goizueta took over. Goizueta was not a traditional soda man. He was a chemical engineer with a brilliantly logical mind. He looked at Coca-Cola not as a beverage company but as a capital allocation machine. He delivered a now famous speech to the company's executives where he declared that their job was not to be preoccupied with unit volume, but to maximize the return on the capital entrusted to them by shareholders. This was heresy. It was a direct assault on the company's institutional imperative. Goizueta initiated a radical transformation. He began to sell off the company's low-return, capital-intensive bottling operations. Instead of owning the factories, he would simply sell the high-margin syrup to franchised bottlers. This freed up billions of dollars of capital. What did he do with that cash? He applied the 5 uses with genius-level skill. He paid down debt, he raised the dividend, and most importantly, he began a massive, multi-year share repurchase program. He understood that the best business in the world to invest in was his own, especially when its stock was reasonably priced. Buffett watched this transformation with growing admiration. He saw a CEO who had broken free from the institutional imperative, Pillar 1. He saw a leader who was avoiding the siren song of diversification and diversification through foolish acquisitions, Pillar 2. He saw a truly rational resistor, a Tom Murphy or K. Graham in the making, Pillar 3. And he saw a master of capital allocation at work, transforming the company's financial DNA, Pillar 4. In 1988, after seeing years of proof that Goizueta's new philosophy was real and permanent, Buffett invested over $1 billion, buying a huge stake in Coca-Cola. He wasn't just buying a brand, he was partnering with a brilliant capital allocator who had turned a great business into an extraordinary compounding machine for shareholders. The investment became one of the most successful in history, a testament to the power of a portfolio strategy built around finding great businesses run by managers who have defeated the institutional imperative. This is the final goal: to fill your portfolio with Coca-Colas run by Roberto Goizuetas. The psychological principles required for an investor to build and maintain such a portfolio are perhaps the most challenging of all, because they require turning the mirror on ourselves. The first and most important is the cultivation of delayed gratification. The path we've outlined is not a get-rich-quick scheme. It is a get-rich slowly but surely and keep-it scheme. It requires the patience to hold a great business for years, even decades, allowing the magic of compounding to work. The 99% of investors are addicted to action. They check their portfolios daily. They are constantly looking for the next hot stock. This constant activity is fatal to long-term returns. Building a portfolio immune to stupidity means being willing to be bored, to let your carefully chosen businesses do the heavy lifting over time. The second critical principle is overcoming the Dunning-Kruger effect. This is a cognitive bias where people with low ability at a task overestimate their ability. In investing, it's rampant. After a few successful trades, the average person starts to think they're a genius. They believe they can predict market movements, time the next hot sector, and outsmart the pros. This overconfidence leads them to take foolish risks and stray from their disciplined process. A truly wise investor, in contrast, has a deep sense of intellectual humility. They follow Charlie Munger's advice: we have 3 baskets for investing: in, out, and too tough. They know what they don't know. They stay strictly within their circle of competence, only investing in businesses and industries they can genuinely understand. They know that their advantage comes not from being smarter than everyone else, but from being more disciplined and more rational. This means you must be willing to say "I don't know" to most investment ideas. The institutional imperative pushes CEOs to participate in every trend. The investor's equivalent is the fear of missing out, FOMO, the urge to buy into a hot stock like Nvidia or Tesla, even if you don't truly understand the business, just because everyone else is making money. A portfolio immune to stupidity is a portfolio free of FOMO. It is a collection of businesses bought for rational reasons, not emotional ones. This requires a strong internal scorecard. You are not seeking validation from the market's daily fluctuations. Your validation comes from knowing that you own a piece of a wonderful business run by an honest and able manager. Whether the stock goes up or down in the next month is irrelevant. What matters is that the intrinsic value of the business is steadily increasing over the years. To put this all together, the applied mental model is the circle of competence portfolio audit. This is a practical exercise you should perform on your own investment portfolio at least once a year. It's a moment of radical honesty to ensure you are practicing what you've learned. Take out a piece of paper or open a spreadsheet. List every single stock you own. For each one, you must answer 3 questions. Question 1. Can I, in simple terms, explain how this business makes money and why it has a durable competitive advantage? If you can't explain it to a reasonably intelligent person in 2 minutes, you are outside your circle of competence. This is an automatic sell signal. You cannot judge the rationality of a CEO's decisions if you do not understand the economic terrain on which they are operating. Be brutal with yourself. Owning a stock because a friend recommended it, or because you like their products, is not a valid reason. Question 2. Have I performed a CEO letter deconstruction and a 5 use of cash scorecard on this company's management? You must have a clear, evidence-based opinion on the quality and rationality of the leadership. Is this CEO a partner in your wealth creation, or a potential destroyer of your capital? If you haven't done this work, you are flying blind. You own a black box, not an investment. The task is to go and do the analysis. If the CEO fails the test, it's a sell. Question 3. If this stock were not in my portfolio today, would I, with my available cash, buy it at its current price? This question is designed to defeat the endowment effect and status quo bias. We tend to hold on to our past decisions just because we made them. This question forces you to re-justify the investment using today's information and today's prices. If the answer is no, you should sell it and redeploy that capital into one of your better ideas. The result of this audit will be a much smaller, more focused portfolio. You might go from owning 30 stocks you barely understand to owning 8 to 10 that you know inside and out. This is not diversification. This is focus investing, the Buffett and Munger approach. Your portfolio is now a fortress. Every company in it has passed a rigorous test of business quality and management rationality. It is now fundamentally immune to the institutional imperative, because you have exclusively selected for leaders who have already proven they can defeat it. This process transforms you from a passive stock owner into an active business analyst and a true partner with the great CEOs of your generation. The antithesis, the path of the 99%, is to build a portfolio based on what can only be described as noise. They engage in constant portfolio churning. They buy a stock based on a news headline or a positive earnings report. A few months later, a negative headline appears, and they sell in a panic. They are perpetually reacting, never acting, based on a long-term, calculated plan. Their portfolio is not a curated collection of fine businesses. It is a chaotic grab bag of recent fads and market rumors. The 99% are herd animals. They buy when everyone else is euphoric and prices are high. They sell when everyone else is terrified and prices are low. They are a perpetual motion machine for transferring their own wealth to more disciplined investors. Their submission to the herd is total. They are, in effect, outsourcing their financial decision-making to the most emotional, irrational, and short-sighted force in the world: the daily mood of Mr. Market. A portfolio built this way has no immunity to stupidity because it is a direct reflection of it. When the institutional imperative leads an entire sector into a foolish trend, the 99%'s portfolio will be heavily invested in that trend. When a charismatic but irrational CEO is on the cover of a magazine, the 99% will be buying the stock. They are guaranteed to be the last ones holding the bag when the bubble bursts, just as they were with dot-com stocks in 2000 and mortgage lenders in 2007. The fundamental mistake is that they believe investing is about predicting the future. They are trying to guess which way stocks will go. The rational investor understands that investing is not about prediction. It is about preparation. It is about building a portfolio of such high-quality, rationally managed businesses that you don't need to predict the future. You can be confident that, over any reasonable period, the intrinsic value of your holdings will grow, and the market price will eventually follow. By choosing to step off this path of constant churning and reaction, you make the single most important decision of your investing life. You choose discipline over impulse, analysis over narrative, and partnership over speculation. The direct financial connection of this holistic approach is the culmination of everything we have discussed. It is the long-term, real-world result of aligning your capital with rationality and against the institutional imperative. Let's quantify the financial transformation. A typical retail investor who follows the path of the 99%, churning their portfolio, chasing fads, and owning mediocre companies, is lucky to match the return of the S&P 500 over the long term. In reality, studies consistently show that the average investor significantly underperforms the market, precisely because of the behavioral errors we've detailed. Let's say the S&P 500 returns an average of 10% per year. Due to poor timing and high transaction costs, the average investor might only achieve a 7% or 8% return. Now consider an investor who has built a focused portfolio of 10 to 15 businesses, each selected after a rigorous audit of its business quality, management rationality, and capital allocation skill. This portfolio is designed to mirror the principles that led to the success of investors like Buffett, Munger, and Tom Murphy. Because these companies are systematically better at deploying capital than the average S&P 500 company, it is reasonable to assume this portfolio could achieve a long-term return of, say, 15% per year. What is the difference between an 8% return and a 15% return over an investing lifetime? It is the difference between a comfortable retirement and generational wealth. Let's say you invest $10,000 per year for 30 years. At an 8% return, your portfolio would grow to approximately $1.13 million. This is a fantastic result, the fruit of diligent saving. But at a 15% return, that same investment of $10,000 per year grows to over $4.3 million. It is nearly 4 times larger. That is the mathematical power of partnering with rational managers and avoiding corporate stupidity. It is the tangible financial payoff for doing the hard intellectual work that the 99% are unwilling to do. This is not a theoretical exercise. This is the demonstrated historical result of applying a disciplined, business-focused investment philosophy. The financial transformation offered by mastering Buffett's test is not about a few extra percentage points. It is about fundamentally changing the trajectory of your financial life, moving from a path of average returns to one of exponential compounding and true, lasting financial freedom. You've made it to the end, and the investment of your time has armed you with a powerful new piece of mental hardware. You no longer see a company as just a name or a ticker symbol. You see a chain of decisions made by human beings. You see the invisible force of the institutional imperative acting on them, and more importantly, you can now spot the rare leader who has the strength to resist it. You've acquired the mental tool to distinguish between a CEO who is building a personal empire and one who is building your personal wealth. This is a profound advantage. But identifying this rational CEO and their mastery over capital allocation is only the first critical step. The institutional imperative is a pervasive force. It doesn't just affect how a CEO spends money. It warps how they price their products, how they manage their employees, and how they react to unexpected crises. Understanding the single dimension of capital allocation is powerful, but understanding the entire system of rational management is how you build a truly impenetrable financial fortress. The video on your screen right now is the next piece of that fortress. It's the essential link that connects the concept of rational management to the idea of a durable competitive moat. It explains the crucial reason why even a brilliant CEO, a master capital allocator, can ultimately fail if they are trapped in a terrible business. It completes the picture, showing how the right manager must be paired with the right business to create the explosive compounding effect we seek. Many people will stop here, content with the powerful idea they've just learned. But those who are truly serious about achieving their financial freedom, those who are committed to mastering the complete architecture of wealth, know that this journey is a continuous process of building their mental arsenal. The choice before you isn't merely about watching another video. It's about deciding if you are going to complete the blueprint. Click and continue your ascent.